Good afternoon, ladies and gents. My name is Simon Brown. I'm hosting this afternoon's webinar with Nedbank Private Equity. We're going to be talking a little bit of private equity, but particularly we're going to be focusing obviously on the Nedbank aspect of it, but we're going to delve into BEE and private equity. That's going to be the key focus of this afternoon's webcast. Joined in studio, Yougan, Moodley and Sarah Thompson, senior members of the Nedbank Private Equity team. Sarah, you're going to appreciate the time this afternoon. Let's kick off with you. Give some insight into Nedbank Private Equity.
Thanks, Simon, for giving us the opportunity to be here today. Yes, Nedbank Private Equity is a private equity investor. We invest in providing expansion capital or replacement capital for businesses in the form of funding management buyouts and management buy-ins, as well as funding empowerment transactions. We are a business unit of the Nedbank Group, forming part of the Nedbank Corporate and Investment Banking Division. So we provide proprietary capital on behalf of Nedbank, and yeah, that's just a background to Nedbank.
Power just went, but the lights will be back in a second. We can carry on. So let's start with some of the spelling myths. We want to delve into what's private equity, but let's get those myths out the way first. And I think the biggest one in many cases is Edcon. Everyone looks at that and says, you see, private equity is terrible. No, the Edcon deal was terrible. Help us with some of those myths that really do need a booting.
Yeah, so there's definitely been a shift from the 90s, the 2000s, where it was all about gearing the business up as much as possible as private equity. So
those phrases,
what's
leverage
called
buyout,
exactly
management buyout. And,
a leverage buyout. And what, for the viewers, what a leverage buyout is that you put as much gearing into the business as possible so that your equity check, or what you pay for the business, is as little as possible. You operate that business lean and mean, so over time you hope that the business de-gears and you boost your returns that way. I think today and in the more recent times there's definitely been a shift away from that model, and for a number of reasons. I think in South Africa we're definitely faced with more curveballs, or businesses have to face with a lot more uncertainty. Look at the riots that happened last year.
Yeah, our power just went.
The power just went. So I think because of that you need to have a bit more fat in your business to be able to sustain through that. And I think COVID's another example where the businesses with stronger balance sheets were able to fare better than others. Even Russia-Ukraine, supply chain disruptions in the east, or the cost of shipping's increased, so you're constantly faced with uncertainty. So that's the one reason. The other reason we don't like to overgear too much is because it distracts management. So management are just, all they're thinking about is getting through the month. They're trying to keep the lights on and they're not focusing on top line growth. So they start cutting costs, they cut the more discretionary spend, like your IT spend or your marketing spend, which is critical for the long-term benefit of the business. So I think although gearing definitely has a role to play in the optimal capital structure, it's never the reason we invest in a business. So it's not our investment, part of our investment thesis.
And debt isn't, I mean, to the point, debt isn't, I mean, a little bit of debt perhaps, but debt's not always right for the right business. And it's a terrible phrase, it's that horses for courses, right? Exactly.
So especially businesses with thin margins, because then if you have any kind of interruption in your business, then suddenly you've got no free cash flow to service your debt.
I hadn't thought of that. Thin margins is a great point. And as you point out, if the 2020s have taught us anything, is disruptions, and they're coming thick and fast. Let's go back to you. It's been certainly private equity. You know, I think back. Let's go back to the Adcon. What was that? 2007 or so. I think a lot of people had probably never heard of it. We're pushing aside those myths there, but it's become a lot more acceptable as an asset class, as something which sort of really can help a business or move to the next level, grow, whatever that case may be, and it's become a lot more accessible and sort of generally accepted as one of the avenues open to a business.
That is correct, Simon. Private equity as an asset class has become better understood and is seen as a real and credible source of funding to both businesses and investors. And this has come about just through the the general passing of time, the asset class has gained a lot of prominence since its emergence around the early 90s. We've also seen a growing investor base from established private equity funds, as well as definitely a growing family office base. We've also had more involvement from industry association bodies like SAFCA, which is the Southern African Venture Capital and Private Equity Association. And then I guess the real impact has been the real evidence and value creation from private equity through adding value to growing businesses, attractive returns to shareholders, and then ultimately an uplift in the economy itself. But if you look at private equity in terms of the available capital that has increased over the years, if you look at just per the SAFCA survey of 2021, in excess of 11 billion rand of funds were raised for private equity. That added up to a total of 206 billion rand of assets under management for private equity, and of that approximately 33 billion is available for future investment. From a Nedbank Private Equity perspective, we would say we have a target to invest approximately R1 billion per annum, and we see the asset class continue to gain prominence and have an impact ultimately in the South African economy.
Sarah, if I bring it to you quickly, some of the Nedbank Private Equity approach, I mean, one of the key things perhaps around private equity generally, but from your angle as well, is flexibility.
Yeah, flexibility is critical. I mean, first of all, in terms of timing, so I think from our perspective, we don't have strict requirements around when we need to exit a business. So if we need to hold the business for 7 years, 10 years, there isn't. We're not like a typical fund where we have to exit at 7 years. And I think the other way that we are flexible is around the instruments that we're able to invest through. So it's not, we don't only invest into equity of a business. We can invest through preference shares, through mezzanine debt, as long as there's some kind of equity return that's linked to that instrument.
Okay, so that flexibility in terms of how you structured benefits to a private equity investor, obviously capital. More than just that, I imagine.
Yes, definitely, Simon. I think the opportunity is also private equity has built up a skill set to be able to go beyond just a pure advisory perspective of putting a deal together. It brings that investment experience to walk through a journey of an investment. So there's a skill set that comes to bear both to incoming investors as well as the business. From a Nedbank perspective, we take certainly an active role in our businesses, so we tend to get involved and support management from a strategic perspective. So our philosophy is one of partnership and allowing our management to have the autonomy to run the business from the day-to-day perspective, but us being able to support them strategically, both as a team as well as accessing resources and networks of the broader Nedbank group.
I was going to say the networking. Nedbank knows people, to put it quite bluntly. And when's an ideal time? I mean, to start to consider this. I mean, the one that always comes to me is generational. You know,
yes.
Someone has built a business. He or she's got it to a great point. They're now, wanting to spend time at the beach or the mountains or whatever the case may be. And the kids are often not for me. But there must be other. That certainly is one. Is yes. When you should be looking to start thinking about this.
Correct. And as you pointed with generational or family businesses, often their wealth is concentrated into the business. So yes. Private equity is an opportunity to bring on board a like-minded investor, and for that particular business to be able to, or the shareholders to realize some value of their investment. It does not mean that they need to exit 100% or to give up control. Those can be maintained. And more importantly, it's an opportunity to retain, let's say, a family legacy or a family vision. So private equity does not disrupt that, but it's more an enabler to be able to crystallize value of the wealth that's been created over the years. Maybe another point that we would say from a value-adding perspective from private equity is to be able to help unlock this stepping change in terms of the business of scaling up, or just an opportunity to bring a different perspective to help get the business to step up to the next level of growth. And that's how we would see how private equity could play a role in terms of, let's call it family or generational businesses.
But I especially like that point. Typically your net worth is tied up in this, and you know, you might only want to golf 3 days a week. You've got to keep some there. So let's come back to you. We're focusing today on empowerment. We're talking about BEE. BEE, topical in South Africa, often for, I think, a bad rap in a perspective, but it is need to be implied, and it's evolved over the years.
Definitely. So I'd say in and around about 2016, 2017, a lot of the codes were amended. So the sector codes, the generic codes. So up until that point in time, it was a lot of transactions were put on hold. They were stalled until there was more certainty around those codes. So from that point onwards, it's been 5 years or so. So a lot of deals have been done, and I think private equity investors have learned what works, what doesn't work. At around about the same time, they also introduced the B Commission. So any major B transaction had to be approved by the B Commission. So that's also added a layer of accountability in the market. And there's definitely less, I mean, the point of the B Commission is to have less window dressing. And I think also through that review process, people have learned what structures work, what funding instruments work from an empowerment perspective. In terms of since then, I think also there's definitely less vendor facilitation. What that means is it's funding from the company to the empowerment partner.
Ah, yes.
So outfits like ourselves, we're able to now fund those partners. So it's third-party funding that comes in. And there are less discounts. So I think the perception up until, for a long time was that you had to give up shares in your business to a BE partner. And that's no longer the case. It's definitely about finding the right partner. And like with any transaction that you do or that a company does, it's more about understanding what value that partner is going to bring to the company. And if you can see they're going to bring value, you may be willing to sell the shares for less than what might be market value.
I hear you on that. Yeah, because they're bringing more than just cash to the table in essence. And that is part of the evolution, I think, both of BEE, empowerment, but I think also of private equity. You spoke a moment ago, Yougan, about how it's not just, write a check. It's, okay, write a check. Perhaps I can, hey, here's someone in an allied industry you could work with. We can introduce you some skill sets at a strategic level. That right partner is so critically important.
Very much so, Simon. So I think, as Sarah touched on, it's about being able to find the right partner that works for that business. And it's more than just bringing capital to a particular business. It's about being able to say, how do you add value to the business of, as I mentioned earlier, to scaling the business up to the next level of growth. So, as with private equity, introducing an empowerment partner befitting for that business could be incredibly valuable to be able to take the business to the next level, as we would say. So from a Nedbank perspective, we've worked with a number of black individual investors or empowerment groupings, and through our networks we are able to introduce those parties to particular businesses, given our history of successful deals across multiple sectors with partners.
And a lot of those empowerment parties or funds, they've specialized in a certain industry. So, for example, you'll get an empowerment partner that's got experience in the ICT sector. So then that's the partner that you would go to, because they've got the experience, the knowledge, and the track record of doing deals in that sector.
Yeah, and rather than a journalist. If you've got questions, folks, send them in on the GoToWebinar app. They are coming through to my phone. We will be taking those questions towards the end of the presentation. We've certainly got plenty of time in that regard. Nicholas, can we go back to you? Private equity, specifically Nedbank Private Equity, supporting that process of black business, black participants in the economy. This has been, it's been in many senses a central theme of our economy, but it's something that you as Nedbank Private Equity is taking really seriously.
Yes. Simon, from a Nedbank private equity perspective, there are a couple of points in terms of which we are contributing towards empowerment funding. Is one, we can bring or introduce capital to a particular deal, and that is capital that's generally not available to somebody generally wanting to buy into a business from from an equity perspective, because it tends to lack the level of security that's generally required from traditional forms of, let's say, commercial or senior debt funding. So that capital is quite important. The other aspect which I touched on earlier, which is the skill set that we bring to bear in a deal, of going beyond just putting the deal together. So we work alongside a new investor into the business, whether it be an empowerment investor or otherwise, but to be able to do it and live beyond just the initial deal of trying to create and realize that value over a period alongside our co-investors. The additional point that I would say is, apart from just going out and finding a partner to a deal or funding a particular party that's been identified as an investor to a deal, we also know that black entrepreneurs and empowerment groupings have been able to build up credible pipeline of deals, and so from a Nedbank Private Equity perspective, we could support them in terms of being able to invest into businesses.
Sarah, there's also, we'll be talking external to a degree, internal. I'm thinking, staff trust. I mean, maybe management and the like, who, and I've heard the story before. I would love to engage my staff, but it's usually vendor financed, as we mentioned a moment ago, where the company kind of funds it. That's sometimes a good or a bad thing, but this can work in that space as well. Yeah,
so that's another thing that we can help structure. So what we'd do is there are a number of options, I guess, that a company can decide to pursue. One being introducing an investor. A staff trust is a great way to increase your empowerment, and also depends on the demographics of your company.
Sure.
But I think doesn't only increase your black ownership, but it can also help incentivize your employees. I saw a stat the other day saying that only 15% of employees globally are engaged in the workplace. So I think it's a way to help motivate your employees. And I think even ourselves, with our own portfolio companies, we've seen that we've been able to generate the best returns where we've got management and employees invested alongside us. And it's obvious why, because if you're all driving towards the same goal of increasing the value of the business, you will drive the growth of the company. So I think that there are a number of ways of fostering inclusion of black participation, and employees is incentivizing your employees through ownership is definitely
it's wider alignment, wider alignment amongst the stakeholders. And I guess an additional point that we could add is, you could get a mix of contribution of empowerment to a business, as Sarah's touching on, staff inclusion. There's external investors that we could potentially fund, but also just as Nedbank Private Equity, we subscribe to the same empowerment credentials as the Nedbank Group, which is currently a level 1 B contributor with 40% black ownership. And so as a business unit of Nedbank, that flows into any of our investee companies or portfolio companies. So we end up with potentially a mix of various empowerment credentials in a business, as from a staff perspective, potentially supporting a black investor into the business, as well as our own Nedbank credentials. Yeah,
and again, it's that flexibility you mentioned. You can structure it. You're not just arriving necessarily with a check. You can say what works best in this particular environment. I imagine. And it's almost a cliche to say, every deal is going to be unique, and you're going to arrive literally with blank pieces of paper and say, tell me your story first.
Exactly, and what do you need to solve for? And then we work from that point.
There we go. Bankers speak for you. What do you need to solve for? I like that. I'm not dissing bankers speak at all. Let's come back to you. What are your requirements for a BE partner?
So generally we want to invest alongside like-minded investors, and that's a prerequisite for us. And it's also relationships that we've built up over years. So it's parties that we've been able to forge good relationships and be able to say, well, what do we want to achieve as a collective? So that is a requirement. The other sometimes is we do historically, I would say, in funding empowerment transactions is require a contribution of some sort from our partners. But given our flexibility to our approach of investing, is we are able to sometimes limit that contribution and be nimble around the particular deal structure of what works for a particular deal. So we have that flexibility in any kind of empowerment transaction.
Are there limits in terms of size of transactions?
Yes, so whether it be from an empowerment perspective or just growth and expansion capital or replacement capital for management buyouts or buy-ins, we would generally say as Nedbank Private Equity we want to be investing around 100 million rand per transaction. again, we have some flexibility just given our mandate, but that we find as a commercial number that works well for us as a business.
Sarah, are there sort of requirements, certain sectors that are BE requirements are perhaps more prevalent? I'm thinking back, the two big ones of the 2000s was financial services and mining. And I remember all of that, and the big mining companies did the deals, the big banks did the deals with, I got to say, mostly actually I think fairly good success in terms of those deals. And again, bringing staff in as well as outside parties. Yeah. But are there other sectors perhaps where there's a bigger requirement at this point in time?
So, I mean, you get the generic codes, which, and you get the sector codes. And sector codes will govern specific industries, like the ICT sector code, like you mentioned, the mining sector, the financial services sector, and they'll all have their different requirements. So, ICT, for example, it requires 30% black ownership in terms of voting and economics. The generic codes, which covers all other companies, they require 25%. So it does differ from industry to industry. I think not only from industry to industry, but also the regulators that govern that industry.
Oh, yes.
So you get ICASA, for example, if we're talking to the ICT sector, they require, this is actually a new rule, but they require 30% black ownership on a flow-through basis, which is there's a slight difference to what the codes say.
What is quickly flow through?
So that means an effective shareholding. So, so if Nedbank owns 50% of a business, it's 40% black owned, then 40 times 50 is 20% black ownership flows through. So you can't make use of, there's a principle in the codes called modified flow through. And that, what that principle means is that if a black partner is more than 50% black owned, I mean, this is quite technical, but then that entity is deemed to be 100% black owned.
Gotcha.
But that's not flow through.
Okay.
Do you know
so
what
flow
I'm
through says no, it's 51, therefore we're not going to credit you with the extra. And this comes back to again what's brought to the table from Nedbank Private Equity, particularly focusing on the empowerment, is the knowledge around the BE transaction. I know a lot of business owners who we're interested, but they don't have the skill set internally. They're not quite sure who to approach to. That's part of what you bring to that table.
Yeah, I think it's the experience we have across a number of different sectors. So we'll be aware that ICASA has that requirement in the ICT sector, for example. And I think customers are another one. So customers like Eskom or other SOEs, state-owned enterprises, they'll have what's called a pre-qualifying criteria for suppliers to be 50% black-owned, to even qualify as a supplier. That's actually under review by the Supreme Court of Appeal at the moment, because they're saying that it shouldn't be a pre-qualifying criteria. It should be something that you assess when looking at a tender or
sort of
a
part
bid,
of the scorecard.
But part of the scorecard, don't disqualify them
before they
without considering price or quality of the product, so we'll see what happens there.
Okay. No, Supreme Court. We've got a great Supreme Court. Talking around, I mean, you've mentioned the Nedbank 40% black owned, which makes it a level 1 BE provider. This is sort of what. Part of what being bought by the Nedbank Private Equity. Talk a little bit around sort of the processes and how companies can be continually recognized as empowered. Because obviously these are processes, they kick off, they run a period of years that might then be. Towards sort of the conclusion of that, there was a question coming through in terms of, if I'm empowered now, does it still last?
Yes, that does not last in all aspects of transactions, and I think those were specific to particular charters. But generally, I think the point that Sarah made earlier, in looking at an empowerment transaction, it does not have to come at a discount to shareholders. So there's, as I mentioned, there's a growing market from a private equity perspective. So there is capital always willing to be wanting to be invested into good businesses. So we do not see trying to undertake an empowerment transaction as an obstacle to a business. So, if you look at the once empowered, always empowered measure, from a Nedbank Private Equity perspective, we don't see that as a challenge from a business perspective, because we find if it's a good business, you will have investors wanting to invest in that, whether it be an empowerment investor or not.
I like that. If it's a good business, the investors are there. That's never the problem if you've got the right process there. And there are other parts. I mean, you mentioned in my notes, there's the YES program, it's the youth unemployment scheme, etc., which can come through. But it's the key point, perhaps, and we've touched on it, and I think to sort of, as we're wrapping up, is that this is not the old belief back in the 90s where I had to give away part of my company, and that's just no longer true. And to Yougan's point, you've got a good business. There's going to be a queue outside your door.
No, exactly. And I think, if you are disposing of shares in your business, and you need to think of what you need as a business first and foremost. So
good point.
Looking at, do you want to exit your business? Do you want to raise capital? And perhaps introducing a black partner to solve that problem, or to solve for that objective, is the route to go, or not.
Maybe if I could add to Sarah's point, I guess, whether you're looking at an empowerment transaction or whether you're looking at, as you mentioned earlier, generational businesses, what is important is to start those conversations early, so that you don't run the risk of value erosion where you leave it for too late. So I guess the role that we could play as Nedbank Private Equity is to be able to help unpack the requirements, whether it be shareholder succession or management succession in that business, empowerment requirements for a business. For us, it's about being able to start the engagement early, so that we end up at the right result for both the business and the investors coming in.
I like that. And if you use an example, so if we're talking a generational, don't wait for your heirs to say no.
Correct.
Actually have the conversation with the heirs and say there are options on the table, and you can say, maybe the heirs are like, no, we do want to be involved, but don't wait for that last minute, because nothing's done well at the last minute.
Very much. And there's always a perception of bringing in new shareholders is complex. The role that we play is to be able to remove that complexity of any kind of transaction, as I say, whether it's an empowerment transaction or just a replacement of shareholder, and also building that management succession into a business is often left unattended to, particularly in long-standing generational businesses.
How's the industry regulated? Obviously there's Companies Act, and then there will be regulations within, if we stick in financial services, there's lots of regulation, FSCA, the Reserve Bank and the like. Is there regulation within sort of private equity?
So, from a BE perspective, it's actually, if you think about it, it's self-regulating, because if I'm trying to improve my own scorecard as a company or as a business, the one aspect of the scorecard is procurement. So if you're procuring from other entities, if your suppliers have a good status level, you benefit from that. So you'll start to put pressure on your suppliers to improve their scorecards, and that way it flows down through the industry. The BE Commission, like I mentioned, they also have a role to play from a ownership perspective. So when doing a new deal, they'll vet that transaction. And then also you've got verification agencies. So every year you'll be updating your scorecard. The one thing to look out for is that verification agency needs to be approved by, I think it's a SANIS approval. So just to make sure that when you're reviewing a scorecard, that it is a credible verification agency.
Yeah, that's the point. Whether you're reviewing one, perhaps I hadn't thought of that part. Whether you're applying for one, make sure you've got a legitimate one. We've got some questions coming through. Folks in the webcast, as I said, you can drop them into the GoToWebinar app. There's a Q&A box there. They will come through to me. Shiraz was asking, given significant lockup periods in PE funds managed the liquidity demands of investors through COVID, you mentioned that, sorry, it was serious. I think you meant that actually part of the beauty of this isn't a fund, so there isn't a date in 7 years where suddenly everything is determined. You've got that flexibility. Perhaps if there was a deal that was looking to terminate sort of mid-2020, you looked at the environment and said, let's wait a year or two.
No, exactly. So we do have flexibility around exit, but I think what I understand from the question, I think in the listed sector, you've got these lock-in periods where they say, okay, the deal is 5 years in length. You can't exit before the end of the 5 years. I think private equity has a natural lock-in because you can't buy and sell your shares quickly. So you have to run a process. You don't typically, it's not as liquid as the listed sector.
Yeah.
So we don't really talk about lock-in periods. It's accepted that there will be a lock-in.
There's, as you said, there's that almost natural lock-in period as well, just because of the unlisted nature of it.
Yeah, and we're not running a retail program for private equity, as I mentioned earlier.
Yeah.
We are investing on behalf of Nedbank, so it's proprietary capital, and so we would generally say there's a 5 to 7 year investment horizon. So, within that horizon, you would have added the value that you wanted, and to be able to then ultimately create that return through an exit that is planned right from the outset somewhat.
Yeah,
so
almost from the beginning.
we're not collecting funds that then results in a lock-in, as you would find perhaps in maybe the legacy type of vendor financed empowerment deals.
Yeah, and there's one, it was a fund, and the challenge they had is because of COVID, they hadn't spent the money. They've only got 3 years left in the fund, and they've still got a pile of cash, and that's that problem with the sort of a term ended. Another question from Shiraz, typical IRR demand, internal rate of return demanded by private equity investors in South African market to entice from the more common asset classes?
I would say the return is dependent on the risk of a particular business.
Okay.
So if you move up the risk curve, then one would expect the IRRs to look like let's call it the old days of the 25% plus IRRs. I think the market has moved, is that the IRR requirements have, or times money back if you want to see it as a return matrix, has come down, but it is dependent on what is the risk profile of the business that you are effectively invested in.
And so this comes back to what we said right up front of this webcast, which is the general broader acceptance of, I want to say, sort of alternative assets as a board group, but certainly private equity, I think, within that, probably as one of the forerunners within that space.
I think it's the asset class with the longest track record, maybe. I think venture capital has definitely become more popular in the last 5 to 10 years. But before that, the venture capital industry was very small. So that's gaining a lot of popularity, and it's a subset of private equity. I think it's definitely, we've proven that the returns can be good in private equity. I think there are often smaller businesses that you're investing in, and they typically have more growth potential.
Good point.
To be able to gain market share and grow their business.
Yeah, but the quantums of investments in a startup is often smaller, and it grows to a point where you go through various rounds of fundings, whereas if you look back to traditional private equity, they look at generally established businesses, so the investment is made maybe at a lot higher level than you would find in an early stage business.
Benjamin's asking, and we touched on this at the beginning, he's asked us to reiterate it, but the different options rather than, you said, Sarah, it doesn't necessarily need to be you're going to be taking equity. There are others, preference shares, I think you mentioned mezzanine finance. You're flexible in how this gets structured. Yeah,
I think both from a BE perspective, so the way we fund a partner alongside us, and the way that we can invest into a business ourselves. And it depends what the capital's been used for. What we can often do is have two instruments, where one's more of a yielding instrument, so we'll have a fixed return, and then another instrument that's got more of an equity upside element. So we do try and blend the two, so that our overall return is maybe somewhere in the middle, but depends what the requirements are.
And this is again sort of that, trying to find something that works for both yourselves as Nedbank Private Equity and for the company. They've got some a need, and hence they've spoken to you, and empowerment potentially, generational, whatever that need might be. You've also, you're a bank. There's shareholders that you've got to report to as well, and boards and the like. And it's finding that common ground, which, the classic, again, a cliche, the win-win, where everyone comes out and says, that was a good deal.
Correct. Our investment model allows us, Simon, to move away from just focusing on just holding, let's say, the ordinary equity ourselves directly. That is one of our preferences, to be able to have an ordinary shielding. However, we are able, as Sarah was touching on, to be able to structure instruments that still allows us to earn the private equity type return that we are looking for the risk that we take. But at the same time, we also want to be able to have the same level of influence through saying, we have an active private equity investment model. So, provided we can structure around those, we don't have to focus only on the ordinary equity aspect of a deal.
Question from Mandisa, and this is a nice one. Many international companies shy away, and they've put shy in the inverted commas, from the broad-based, from the empowerment deals concept generally due to lack of value creation, or perhaps even value add from shareholders, locked-in returns and passive investors. Has this changed? My sense is from the conversation with the two of you this afternoon and from what we've seen happening over the last couple of years is certainly maybe the international investors haven't noticed the shift, but there has been a marked shift in the empowerment space.
Yeah, I think for international companies, there are different requirements for them. I think they've got to, you don't necessarily have to give up ownership in the business, but it's sometimes actually a simpler way to structure it for them. I think that they just have various options that they can achieve the same outcome. But there has been a move away from offering massive discounts, long lock-ins, a lot of vendor facilitation. It's no longer just a tick box exercise trying to tick the boxes from a scorecard perspective. It's rather that allowing that investor to add value to the business.
It's gone back to its roots. It's empowerment now. We can now focus on and saying there's a need here and we can bring empowerment to it, rather than there's a need here and we can bring a box and tick them all. That really has been the biggest shift perhaps in the last decade.
And I think shareholders, as an empowerment investor coming into a business, they are demanding more than just being part of a tick box exercise, but actually wanting to be able to actively add value to a business. So there is a shift, as you point out, from the investor side as well. So a local investor partnering with an international wants to be able to be actively involved in their business, as opposed to just ticking just the ownership aspect of a deal.
I'm going to leave that there. I'm not seeing any more questions coming through. My list is dry. So how can someone contact Nedbank Private Equity if they're interested?
Yeah, perfect. You can reach us through our Nedbank website, and you could look through the Nedbank Corporate Investment Banking web page, and within there's a link to private equity. Alternatively, you Google or use your search engine, I should say, Nedbank Private Equity. And alternatively, you can contact Sarah, myself, or any of our team on LinkedIn. We all have our profiles updated on LinkedIn.
Yeah. And you say that as if there's another search engine out there. Bing, that's right. Bing, my bad.
Search engine, yes.
You did Google's become it. We'll leave it there. Really appreciate the time. Yeah. We've been chatting with Sarah Thompson, Yougan, Moodley. They are both senior members of the Nedbank Private Equity. Talking private equity, but talking particularly with empowerment. And I think the two things that really struck me in this conversation was private equities sort of evolved and changed from, as Sarah said, where it was in the 90s, but so has empowerment. And I think both of those are good, not just for investors and Nedbank and corporates out there. I think it's good for South Africa as well. My name is Simon Brown. Thank you for your time this afternoon.